Modi. Among the deals that will be signed include those that concern law, culture, science, and technology. Investors this week scour for catalysts. Philippine July inflation is out tomorrow and second quarter GDP data on Thursday. Senior economist Vic Abola of the University of Asia and the Pacific and DepDev Undersecretary Rosemary Edilion join us live. And exporters say the country may have lost the Philippines' competitive edge as neighboring ASEAN countries get similar tariff rates from the U.S. President Bongbong Marcos begins the week with a state visit to India, marking 75 years of Philippine-India diplomatic relations. The visit comes with the U.S.'s trade policy threatening to disrupt the global trade order, with India facing 25% tariffs and the Philippines 19%. Our mobile journalist, Julie Baisa, has details.
Cathy, President Ferdinand Marcos Jr. is set to fly to India this morning for a 5-day state visit. He will stay there from August 4 to August 8. In New Delhi, the president is scheduled to meet with the Indian President and Prime Minister Narendra Modi. He will also have a meet and greet with the Filipino community there. After the events in New Delhi, the president will head to Bangalore, India, often referred to as the Silicon Valley of India. There, he will meet with business leaders and entrepreneurs. The president's goal is to secure business investments during the visit.
That was Julie Baisa reporting to us earlier. A group of exporters says the Philippines appears to have lost its competitive edge in the U.S. market, given the similar rates that our ASEAN neighbors have received. Manila got one of the lowest tariff rates when U.S. President Donald Trump announced the first salvo of duties on Liberation Day, April 2nd. But the Philippines ended up with a tariff rate that is 2 points higher than what Trump initially threatened. In comparison, other members of the ASEAN Plus 5, or the bloc's largest economies, as well as Cambodia and Vietnam, got substantial discounts to bring down their rates between 19 and 20%. Philexport President Sergio Ortiz Luis Jr. told Business World Manila's 19% tariff poses a problem since the rate is now matched with direct competitors. This could result in lower demand for Philippine exports in the U.S. and little room for exporters to increase prices. Finance Secretary Ralph Recto previously said the Philippines stands to lose between 3 and 6 billion pesos in revenues for the opening up of the market to U.S. goods duty-free as part of the government's concessions. DTI Secretary Cristina Roque, one of Manila's trade negotiators, told this program last Friday that the playing field is equal, but urged exporters to explore other markets.
Actually, if you really look, everybody's with tariff. So that actually evens out also the playing field there. So, but for me, I encourage the exporters to find other avenues or other markets other than the U.S. So they can still continue with the U.S. market, but it's really best for them to find also other markets.
Meanwhile, U.S. Trade Representative Jamieson Greer told CBS that the rates are likely to stay in place rather than be cut as part of continuing negotiations. While Trump lowered levies in some countries, this isn't the case in the most recent round of announcements. The tariffs are set to take effect on August 7th. The Philippines' second quarter GDP data will be released this Thursday, August 7th. But before that, all eyes are on the July inflation results set to be released tomorrow, Tuesday. Recent projections suggest a further slowdown in the consumer price index. A Business World poll of analysts estimates headline inflation eased to 1.2% in July within the Bangko Sentral ng Pilipinas' forecast range of 0.5 to 1.3%. If realized, this would be the lowest inflation print in nearly 6 years, or since October 2019. Economists attribute the slowdown to lower food and fuel prices, particularly rice, after tariff cuts and price caps were implemented. However, some flagged upside risks, including higher electricity rates and weather-related disruptions that may have impacted food supply. Still, with inflation below the Bangko Central's 2 to 4% target, analysts say there is room for a rate cut at the August 28th policy meeting. Others, however, caution that the central bank may hold off amid global risks and continued pressure on the peso. And joining us this morning is Undersecretary Rosemary Edilion of the Department of Economy, Planning and Development. Good to have you back, USEC Rose. Welcome to the program.
Yes, good morning, Cathy.
So President Marcos is flying out to India for a state visit. What more can we expect?
Oh yes, we're quite happy with this one. Actually, we already have an FTA with India, but it is through the ASEAN. So that's the ASEAN India FTA, and there has been talk actually earlier this year if we could have a bilateral agreement with India, because a bilateral agreement would give us more flexibility. And yes, actually the agreement was to go beyond scoping and now go into the real negotiation.
So how much more flexibility, USEC Rose, and what would that mean for our current bilateral trade relations with India?
Yes. So like I said, right now our trade relations with India is actually through the ASEAN. So therefore, any agreement we have should actually be agreed upon by all the ASEAN member countries. So it's kind of difficult to put in more of this good terms, good trading terms. But right now, then we can have better agreements with them. We're looking at aspects like trading, like in automotive, um, the battery value chain, pharmaceutical value chain, of course, the pharmaceuticals itself, and of course your fintech, other investments. Actually, because India is also very big on the digitalization.
It is, and it's a huge market that's also a
It
part of
is.
BRICS. So, do you have any
Mhm.
figures as to how much so far we're doing and how much could be had with any of the
Yeah.
agreements that can be signed in the next few days?
Yeah, none yet on the forecast, but so far, India actually, interestingly, up until last year, our exports to India makes up about 1.5% of our total exports. But like I said, as early as February of this year, when they started talking and the possibility of having bilateral agreement, actually the share of India of our exports to India increased to 2.1%. So I'm sure that it will increase further once an agreement is reached.
And what could extrapolate from that it could also be good for the local economy, especially that we're going
Yes.
to receive and see how the GDP had done in the second quarter. How much of that economic slowdown, though, is because of domestic reasons, growing more slowly than 6%? And how much or little of it is aggravated by the lingering uncertainty of higher tariffs?
Yeah. Well, right now, especially looking at the first quarter, actually domestic demand is very robust. So it's not really the internal factors that was responsible for that slowdown in the first quarter. For the second quarter, well, there will still be that the impact from the rest of the world, and therefore net exports could actually be slowing down, but still not negative. So we're actually very hopeful about the second quarter, judging from, there's lots of other activities. As you know, we had the election in May, and also the good weather during the second quarter. So I hope it all aligns, and we'll know for sure, of course, by Thursday.
Do you have a target or a forecast target? If it's not 5.4%, if it's faster than the first quarter, what could it be in the second?
That will have to wait until Thursday.
All right. Well, the finance secretary himself, Ralph Recto, was quoted last week saying that the Philippines could forgo revenues of between 3 billion and 6 billion pesos a year because of those zero tariff concessions granted to select U.S. goods. What is DepDev's own computation, and what impact is it going to have on total revenues and overall GDP?
Yeah, so actually, like Secretary Roque has said, the negotiation is still ongoing. But from the initial discussion with SecGo, his initial announcement at least, where he mentioned about soybeans, about wheat, automobiles, and then the pharmaceuticals. So for the soybeans and wheat, these are actually aligned with our strategy to reduce input costs. And so with the lower tariffs coming in to the country, yes, there will be reduced tariff revenue, but we're thinking that this could actually be beneficial to our MSMEs, those in the bakery, those even those manufacturing the feeds, because soybeans and wheat actually are very are actually an important component of feeds. Now, for the pharmaceuticals, that would actually give us more choices for pharmaceuticals. So, as you know, we really want to bring down the cost of medicines, especially the specialized medicines. So, we're hoping that that is actually the direction that we're going.
So how much of an impact then in consumer prices, if this is really going to be good for the local MSMEs, and when can we feel the impact? How soon?
Well, the impact is we'll have to wait until the negotiation is done, and everything has to be. Of course, there has to be that signing by both countries. But actually, just on the 19% tariff that was imposed on us. Okay, so minus Singapore, then we're actually looking at better than our neighbors in terms of the tariffs. If we had been given the same tariffs, among across all ASEAN, it will if it's the same, then that means we're just back to where we were before. But the thing is, there was, a slight concession on our part, and the thing is, for many of our exports to the U.S., these are actually exempted from the reciprocal tariffs. So, like your semiconductors, these are exempted. Your wood products, these are exempted, and these are our major exports to the U.S. So, in fact, we actually simulate that there will be a very slight positive impact on us. And this is really by way of trade diversion. Of course, another thing that, like Secretary Roque said, we should be looking at the other markets so that, if the reduction in demand from the U.S. Really gets realized, then we have to find additional alternative markets for our products.
But do you agree with exporters right now saying that we lost our competitive edge because the tariffs in other ASEAN nations were lowered just as well?
Um, Actually, like I said, it will be the same as before. If it will be the same tariffs that was imposed on us, then we're back to where we started. And if the thing is, if we have been a major exporter of a particular commodity, then that means we are the ones with the comparative advantage. Of course, we would have wanted, the previous set of reciprocal tariffs where we were imposed a 17% tariffs, but 19% will still take it. And like I said, uh, pertaining to our major exports to the U.S., then these are actually exempt from the tariffs, and therefore, you know, it will be the same situation as before. I think we have lost competitive edge pertaining to our agricultural products, and so the thing to do there is really to look for other markets for that.
Okay, well, we'll leave it there. Thank you so much for the insights, Yusek Rosemary Edilion of DepDev. Appreciate it. You're watching Money Talks. Coming right up, a raise in oil production continues in September, and economist Vic Abola gives us his second quarter GDP growth forecast. Keep it here on One News. Welcome back to Money Talks. I'm Cathy Yang. The Organization of Petroleum Exporting Countries, or OPEC Plus, has greenlit a raise in oil production for September, marking a full reversal of last year's output cuts. The 8-member oil producers group has agreed to hike a 547,000 barrels per day. OPEC Plus countries started in April to regain 2.2 million barrels per day of previous production cuts. The group cited a healthy economy and low stocks as reasons behind the output hike. Oil prices slipped in early Asian trade this Monday as a result of OPEC's decision. Benchmark Brent crude now down by nearly 0.5% to 69.33 a barrel, while West Texas Intermediate falls by 0.4% to 67.02 a barrel. U.S. markets tumbled on Friday after a weak jobs report and revised tariff plans renewed investor fears. The Nasdaq led those losses among equities, sliding by nearly 2.25%. S&P 500 ticked down by 1.6%, and the Dow fell by 1%. Benchmark 10-year Treasury yield settled to 4.218%, the biggest one-day decline since April, while gold rose to $3,347 per troy ounce. As for U.S. futures, they're pointing to gains when the markets open later tonight, Manila time. Both the Dow and the S&P are up by 0.2%, and the Nasdaq ticked up by 1/3%. As for Asian markets, they're mostly down in early trading this Monday. Investors assessing the latest round of tariffs and U.S. jobs reports. Japan's Nikkei 225 leading those losses, down over 2%. Australia's ASX 200 falling by 0.1%, and South Korea's Kospi up by over 0.5%. Let's take a quick check on the Philippine market, see how the PSEI has opened this Monday. It looks higher by 0.1% at 6,315. The local bourse snapped its 6-day losing streak last Friday to advance by 0.8%, driven by bargain hunting. The broader all-shares index rose by nearly 0.4%. Local counters were in the green except for mining and oil. As for the Philippine peso, it opens this Monday stronger, 57.75 to the dollar. Peso strengthened last Friday to 58.145 against the greenback. And 10-year government bond yields ticked up to 6.203% from the previous close of 6.198%. Philippine Stock Exchange Index may continue to decline in the near term. Chief Investment Strategist Ron Acoba of Trading Edge says the short-term trend has shifted to a bearish stance following the recent breach below both its 100-day moving average and its most recent reaction low of 62.95. The index, he says, appears poised to retest its June low of 62.04. As for the dollar peso, Acoba says after having reached a new 4-month high of 58.22, the currency pair has since retraced 57.70. The recent upward breakout in the currency pair remains intact, maintaining its position to potentially revisit its all-time high of 59.08 to the dollar. Our continuing discussion on the economy. Our next guest forecasts GDP growth for the second quarter to come in at 5.7% year-on-year. With us now for more is senior economist Vic Abola of the University of Asia and the Pacific. Good to have you back, Vic. Welcome to the program.
Good morning, Cathy. Glad to be here.
Okay, so how did you come up with
contribute whatever I
5.7%
can.
for the second quarter?
Well, that was a pickup in infrastructure spending, and I think there's also a late surge in consumer spending. I was in touch with Jollibee. They said their second quarter had been quite good. So I think it should be okay. I mean, except that we had a weak April, but May and June were very robust. So I still think it will reach 5.7, but we'll have great difficulty breaching 6%.
How sustainable, though? I mean, reaching 6%, Vic, on what constants or variables? Because presumably the August 7 tariff deadline will lapse, and there would be an increase in tariffs.
Yeah, number one is the rate cuts. the rate cut is so important for a number of reasons. Number one, I'm advocating for a 50 basis points rate cut. 25 is just a sort of a uh, tiny, cut that there's not much what we raised during the time when there was inflation. There's no threat of inflation. I expect inflation to be at around 1% for July, given relatively weak oil prices and as well as food prices. Although you have vegetables always gets, but that's not important enough because rice prices are down. When we look at the Vietnam export prices of rice, is lower than it was and by the end of 2022, just when it started going up. And the forecast for oil all the way up to 2026 by the Department of Energy of the United States is downward. So, and a global economy that has weakened, including the United States, there's no reason why we should be fearing about inflation. As a matter of fact, if we look at the real yields of 10-year bonds, it's like in the top 1.8% percentile. So it's too high. So number one, your residential construction or the residential buyers are inhibited because it depends so much on your monthly amortization. Secondly, you have firms that are hesitant to borrow, to expand, and then overall construction activity gets bogged down.
Right.
Um,
Vic, talk to us about the rate cut that you mentioned, 50 basis points. If we factor in the impact of the tariffs, and I know that you did some maths here, USEC Rose there made a mention of the impact of zero tariff concession and revenues, but what about the impact of 19% tariffs of Philippine exports to the U.S. and the impact it will have on GDP and the need for the BSP to possibly cut a lot more than 50 basis points?
Yeah. In the exports, as Jones has explained, I estimate only around 6 billion of our exports will be affected because there are a lot of exemptions. So it's not very, very large in terms of our impact on us, and we'll be at the same boat as the other ASEAN countries. However, on the other side of that, that's not you know, very much considered is the impact on the local exporters' profit bottom line, right? Because if you right now have to pay 17, or you will get 17% less from what you export, you either raise your prices or bite the bullet, partly at least. That might slow down the exports a little bit from where we are. We had a very strong June, but I think that we can still manage with a 10% growth for this year, despite the situation. And I think that, in terms of competitiveness, the main problem is not the tariffs. I mean, what we need to do are, mentioned, cut policy rates sharply. That does not only help private sector, it will also help government in the terms of their fiscal space. 1% drop, 100 basis, okay, a half percent, let's say a half percent cut can my estimates around close to between 5 to 10 billion pesos in interest savings
Could
of
I
the
pick up
government.
on
That will
peso, Vic?
offset.
Because very important that you make a mention of the role that the local currency has in managing the impact of slower growth and faster inflation. Right now, we are at a 29-month low in the peso
Yeah,
against the dollar. Where would the
yeah.
peso have to go to cushion
Well,
the
it will
impact
have to go.
that we have to protect exporters from the tariffs?
Yeah, you will have to go. At least you'll have to go down by 5% because assuming that the buyers in the US agree to a split of the profit of the price. So you should be depreciating it, allowing the currency to depreciate by at least 5%. That's not too much because that's only about 2% in terms of, you know, and if you look even the BSP studies, former Governor Tatango used to say that a 1%, or let's put it 2%, only results in 0.2, there about 0.2% increase in inflation. Now, my own annual forecast for the inflation is 1.6%. So we're way below the targets. So BSP can afford. The problem is not inflation. It has shifted to growth because we've seen it in the first quarter, and we're not achieving the 6% because the focus is wrong. I mean, the focus is the growth because our problem now is that we'll have a lot more of imports from China. China will divert its exports away from the US. Also, we should expect more imports from India. All of these countries that have a big economies be exporting to us. So we really have no choice. We have to depreciate the currency in order to protect
Okay,
local
we'll have to leave it
producers.
there, Vic. So much to talk about, but we'll know the lowdown in the next 24 hours with inflation out and GDP in the next 72. Thank you so much, Vic Abola of the University of Asia and the Pacific.
Sure.
And in corporate news, Meralco's power generation arm is doubling down in capacity in the next 5 years. Meralco Power Gen, or MGen, expects to deliver over 10,000 megawatts of net sellable capacity and more than 5,000 megawatts of attributable capacity, double the current levels. MGen President and CEO Emmanuel Rubio credits growth projects like the Terra Solar Farm and its battery energy storage system, as well as the upcoming coal plants in Quezon and Cebu. For his part, Meralco Chairman and CEO Manny Pangilinan says they are on track to hit a 50 billion peso profit by the end of this year. The Bank of the Philippine Islands expanding abroad once again, this time bringing its fund management services to Singapore by October. BPI President and CEO DG Limcauco confirmed the bank secured a capital market services license from Singapore's Monetary Authority after filing for it a year ago. The move was announced as BPI celebrates its 174th anniversary after logging strong first-half earnings and projecting continued growth through the end of the year.
We received notice from the Monetary Authority of Singapore, the MAS, that our application to open an office in Singapore was approved. So we hope to open this office and inaugurate it by early October. It's not a full branch. It will be focused on investment products for our clients. The clients can either be Filipinos who are based in Singapore or the ASEAN region, or Filipinos anywhere in the world who wish to hold assets and gain access to international assets that may not be available here in the country.
The BPI Wealth Singapore office will rise inside the Marina Bay Financial Center alongside global firms like Standard Chartered and Baker McKenzie. It will cater to preferred and high net worth clients, those with investable assets ranging from 1 million to 50 million pesos. And that is it for Money Talks. I'm Cathy Yang. Catch us again tomorrow, 9:30 a.m. here on One News. Have a great day ahead.